This is not financial advice, and I am not a financial advisor.
This is just me talking about my personal financial journey. This is for entertainment purposes only.
Enjoy the show.
Charlie Munger famously called Bitcoin rat poison. But what if I told you that feeding a little bit of rat poison into your portfolio might be the exact psychological trick that guarantees you become a millionaire?
Oh, wow. Okay, bold claim.
Right. But welcome to today's deep dive. We are talking directly to you, the listener, because today we're doing a custom-tailored analysis of your exact financial milestone.
Yeah, and the, highly unconventional way you actually achieved it.
Exactly.
Because this isn't just some theoretical discussion. We are opening up the hood on a very specific snapshot today.
I'm super excited for this.
Me too. We're looking at your portfolio sitting at a total net worth of exactly $112,202.
Such a specific and awesome number.
It really is. And our mission today is to take that number, isolate the specific assets that make it up, and kind of stress test them.
Right. Stress test them against the philosophies of one of the most brilliant and honestly ruthless investors of all time.
The late Charlie Munger.
Exactly. Because the tension in your portfolio is just fascinating. I mean, you have achieved an incredible milestone crossing that six-figure mark.
Absolutely.
But the modern mix of assets you use to get there, it sets up this massive collision between like old school rigid mathematics and modern behavioral psychology.
It really does provide the perfect lens to understand a major conflict in finance today.
Yeah, big time.
We're basically looking at the strict mathematical realities of compounding on one side and then, the overwhelming macroeconomic anxieties of the modern retail investor on the other.
Right, but achieving that initial $100,000 milestone requires a massive psychological toll.
Oh, absolutely.
And it's a toll that actually explains a lot about why your portfolio is built the way it is. Yeah. I mean, to get to $112,202, you had to fight the math.
You did. And Munger had a very blunt, very famous quote about this exact phase of wealth building.
Oh, I know the one.
Yeah, he said the first $100,000 is a bitch.
Which is just classic Munger.
Mm-hmm. Right. But he wasn't just being colorful. There is a deep structural reason why he believed that.
Because when you start from zero, the exponential curve of compound interest is, well, it's practically flat.
Exactly. It does virtually nothing for you.
Let's actually look at the mechanics of that. Like if you start with $5,000 and the market has a stellar year returning 10%, you've made $500.
Right.
Over 12 months, that $500 barely moves the needle. I mean, it certainly doesn't shave years off your working life.
Not at all. The math is entirely linear in the beginning. Getting to that first 100K relies almost entirely on brute force savings, right?
You are the engine.
Yes, you are. You have to deny yourself short-term consumption, funnel a massive percentage of your income into investments, and just accept that the market isn't going to bail you out.
Or accelerate your timeline.
Right. It is purely an exercise in behavioral endurance.
You essentially carry the entire portfolio on your back until the sheer mass of it gets heavy enough to start generating its own momentum.
And you did that. You really did.
Yeah, you carried it to $112,202. So let's lay out the exact foundation you built to get here.
Let's hear it.
Okay, here is your current portfolio snapshot. You have $4,700 in cash.
Okay, solid emergency fund.
Right. Then you have a massive chunk between $81,000 and $91,000, depending on the daily spot prices.
And that's sitting in equities, meaning broad market stocks and index funds, right?
Exactly. But then you have $5,000 in crypto.
Interesting.
You have 2.85 ounces of physical gold.
Okay.
And you have 138 ounces of silver.
Wow. And, that specific breakdown is kind of where the celebration ends and the mathematical scrutiny begins.
Uh-oh.
Because you undeniably mastered the discipline Munger demanded. You brute forced your way to the milestone.
Right, which is huge.
It is. But allocating roughly 15% of your net worth to crypto and physical metals represents a massive philosophical drift from the very mechanics that Munger used to build wealth.
I'm struggling to reconcile this a bit, because if Munger is an investing genius, why do so many smart modern investors hold these exact alternative assets?
It's a great question.
Are they just being completely irrational, or is Munger's traditional framework missing something about, the modern economy?
Well, mathematically, Munger's framework is ironclad, and holding those assets is irrational if your sole goal is compounding.
Okay, so unpack that for us.
We have to look at how Munger defined a productive asset. He believed that true exponential wealth generation only happens when capital is deployed into a living, breathing economic engine.
Meaning like an actual business that solves a problem and generates free cash flow.
Yes, exactly. A productive asset captures a margin between its costs and its revenue. It takes that profit and either reinvests it to grow the business or it pays it out to you as a dividend.
Right, and then you take that dividend and buy more shares in the business.
Precisely. That creates a recursive loop. The math compounds on itself. The value of the asset grows independently of market sentiment because the underlying business is literally generating new capital that didn't exist yesterday.
That makes total sense. But the $5,000 in crypto, the 2.85 ounces of gold, and the 138 ounces of silver, they do not do that.
They do absolutely nothing. Your 138 ounces of silver will never produce a 139th ounce of silver, no matter how long you leave it in a safe.
Right, it just sits there.
In fact, physical metals often have a negative yield because you literally have to pay to securely store and insure them. These are non-productive assets. Their entire value is predicated on capital appreciation.
Which is essentially the greater fool theory.
Exactly.
I mean, the only mechanism for you to make a profit on that silver or that crypto is a hope that eventually someone else will come along and be willing to pay more for it than you did.
And that is a zero-sum game. Munger despised that. It's the core reason he called Bitcoin rat poison.
It wasn't just like an old man yelling at clouds.
No, not at all. He fundamentally objected to the mechanics of it. He viewed crypto as a system that relies entirely on an endless stream of new buyers injecting liquidity to prop up the price.
Without the underlying network producing any tangible utility or cash flow.
Right. So to a traditionalist, allocating 15% of your hard-earned foundation into a zero-sum asset class is a staggering opportunity cost.
Let's talk about that opportunity cost, actually.
Okay, so if you take that roughly $15,000 tied up in alternatives and you put it in a broad equity index fund returning a historical average of, say, 8% annually.
Right.
Over 30 years, that $15,000 turns into over $150,000.
Wow.
Yeah. By keeping it in non-yielding metals and crypto, you are voluntarily paralyzing a massive chunk of your wealth's compounding potential.
Look, I understand the raw math. I really do. But I want to push back heavily on Munger's dogma here.
Okay, let's hear it.
Because the math of compounding does not exist in a vacuum. It exists inside human brains. And honestly, human brains are incredibly fragile when it comes to risk.
Fair point.
So the 15% you have in those alternatives isn't just a mathematical error. I argue it's a modern survival mechanism.
A survival mechanism against what, exactly? I mean, the stock market has consistently recovered from every crash in history and just continued to compound.
Against our own psychology. I mean, think about the concept of fiat debasement.
Okay.
That $4,700 you have sitting in cash is constantly losing purchasing power due to inflation. We live in a cycle of rapid money printing, wild macroeconomic swings, and a 24/7 news cycle that is basically designed to induce panic.
That's true. The noise is louder than ever.
Exactly. So when an investor sees the government printing trillions of dollars, holding a tangible asset like gold, which has served as a historical hedge against currency collapse for thousands of years,
Right.
it provides a specific utility that Munger's math just ignores entirely.
Well, I will concede that metals provide a historical sense of stability, but they still don't produce cash flow to outpace inflation the way a strong business does.
Sure.
A business can raise its prices to match inflation. Gold just sits there.
True, but we need to look at the concept of the psychological barbell. Let's re-examine the mechanics of your portfolio.
Okay.
The vast majority of your wealth, roughly 80%, so that 81 to 91 grand, is doing exactly what Charlie Munger wants.
Right. It is compounding in stock index funds.
Exactly. It's a heavy, mathematically optimal weight on one side of the barbell.
So you're saying that 80% is the actual engine and the 15% in alternatives is just something else entirely?
Yes, exactly. I want to look at that 15% through the lens of earthquake insurance.
Okay, I like this analogy.
Now, standard earthquake insurance is mathematically a terrible investment. It has a negative expected value.
Right, the premiums you pay are just gone.
Exactly, they don't compound. And the insurance company only writes the policy because the math heavily favors them.
But people still buy it to prevent catastrophic ruin.
Yes. And more importantly, they buy it for the psychological comfort of knowing they won't be totally wiped out. In investing, the concept is called correlation.
Right, how assets move in relation to one another.
Exactly. Equities have a high correlation to the broader economy. So when the economy tanks, your $91,000 in index funds tanks right with it.
But gold, silver, and historically crypto often act as non-correlated assets.
Bingo. They don't move in tandem with the stock market.
Sometimes they even move inversely. Like when panic hits the traditional markets, capital flees into tangible assets, spiking the price of gold.
And that inverse correlation is the magic trick here. Behavioral economics teaches us about loss aversion.
Oh yeah, the psychological reality that losing 10 grand hurts twice as much as gaining 10 grand feels good.
Right. So if the stock market drops 30% tomorrow, Munger's approach requires you to just sit on your hands, watch tens of thousands of dollars evaporate on paper, and blindly trust the long-term cash flows of the underlying businesses.
Which is agonizing for a normal person.
It forces you to fight every evolutionary instinct you have.
Right.
But if you log into your account during a market crash and you see that your 80% in equities is bleeding, but your 2.85 ounces of gold has spiked and your crypto is holding its ground.
It short circuits that panic response.
Yes. It gives you a tangible anchor outside the fiat system. Even if it's only 15% of your net worth, the psychological comfort it provides prevents you from committing the ultimate financial sin.
Panic selling the equities at the bottom.
Precisely. If holding a little bit of Munger's dreaded rat poison gives you the peace of mind to sleep at night and keeps you from liquidating your index funds during a crash, then that 15% in non-productive assets isn't an opportunity cost.
It's the insurance premium you pay to protect the compounding engine. You know, that is a really compelling defense of modern retail behavior. The math is undeniably compromised by holding non-yielding assets. But if the investor's psychology is fragile, a mathematically imperfect portfolio that you can actually stick with during a panic is far superior to a mathematically perfect portfolio that you abandon at the first sign of trouble.
Which brings us to the most critical part of this analysis. Getting to $112,202 was the crucible. You built the foundation.
Right, but compounding relies on forward momentum. We have to map out the road to the next 100K.
Because moving from 100K to 200K is a fundamentally different mechanical process than going from 0 to 100K.
Oh, completely. This is where the paradigm shifts and the mass finally steps in to do the heavy lifting for you.
Right.
Think about the $10,000 you might save this year. When you had 0, that 10K was 100% of your growth.
But now you have over 100,000 working for you.
Exactly. A 10% market return generates an additional $10,000 entirely on its own. Your portfolio is suddenly matching your brute force savings rate. The snowball is finally rolling downhill.
So how do you manage the tension in this portfolio moving forward? I see two distinct paths for your journey to 200K. Let's map out path 1, which we can call the Munger purist.
Okay, path 1 requires ruthless mathematical optimization. It means entirely abandoning the psychological barbell.
So you look at the 138 ounces of silver, the 2.85 ounces of gold, and the 5 grand in crypto.
And you liquidate all of it. You extract that $15,000 and immediately deploy it into your equity index funds.
Now, I know exactly what you were thinking as you hear this. You're thinking about the sheer logistical hassle of hauling physical silver to a dealer.
Oh yeah, and you are definitely calculating the capital gains taxes on the crypto.
Right, and you're probably dealing with the sunk cost fallacy or, just an emotional attachment to assets you've held through wild, volatile swings.
Those are completely valid behavioral hurdles. But look at the raw mechanics of pushing through them. By moving that 15 grand into equities, you are instantly increasing the mass of your compounding snowball by nearly 20%.
Which is huge.
It is. You are transitioning 100% of your net worth into productive cash flowing assets. You're letting go of the psychological crutches that helped you survive the first 100K and trusting the mathematical engine to carry you to 200K faster.
So it is the optimal path for absolute wealth generation, assuming your stomach can handle the volatility without the safety net of the metal.
Exactly. Which leads us to path 2, the modern pragmatist.
Right. If path 1 feels too exposed, path 2 acknowledges your behavioral realities.
So what does path 2 look like?
In path 2, you don't liquidate a single thing. You keep the silver in the safe. You leave the crypto on its cold storage wallet. You hold the gold.
Okay.
But, and this is the absolute crucial mechanism here, you treat that alternative allocation as a strictly capped fixed bucket.
Ah, I see. You quarantine it. You accept that it serves a psychological purpose, a hedge against macro uncertainty, but you stop pretending it is the primary engine of your wealth.
Exactly. From this day forward, as you deploy new capital on the road to 200K, 100% of your new savings goes strictly into compounding equities.
You do not buy ounce number 139 of silver.
No, you don't average down on your crypto. You let the alternative bucket slowly dilute as a total percentage of your net worth over time.
While aggressive new capital just feeds the index funds,
Right.
this strategy isolates the mathematical drag. Your $15,000 in alternatives might not compound, but you stop throwing new, highly valuable capital into a non-productive void.
Exactly. You maintain the psychological comfort of the barbell, but force supreme discipline on your future cash flow.
This requires brutal honesty, though. You really have to ask yourself a hard question about those specific assets.
You do. You need to evaluate the intrinsic motivation behind holding them. Are they genuinely serving as a non-correlated hedge that allows you to sleep at night when inflation headlines hit?
Or if you look deep down, are they just a distraction?
Right. Are they assets you bought because they were exciting, volatile, and promised rapid appreciation, and now they are simply pulling focus from the boring, relentless math of your index funds?
If they are a distraction, well, the math proves Munger right. They are paralyzing your potential.
But if they are the emotional anchor that prevents panic, their value isn't measured in dividends.
No, their value is measured in the disaster they prevent.
Let's pull this all together. You have conquered one of the most brutal phases of personal finance. You survived the linear grind. You fought through the lack of momentum, and you built a massive six-figure foundation of $112,202.
And the sheer discipline required to accumulate that capital, especially the $81,000 to $91,000 sitting in productive equities, is proof that you possess the behavioral grit required to build serious wealth.
And you did it by building a portfolio that perfectly encapsulates the modern retail investor's dilemma. You harnessed the mathematical power of traditional equities for the heavy lifting.
But you utilized non-productive, non-correlated assets to build a psychological fortress against the anxieties of fiat systems and modern macroeconomics.
The challenge as you move toward 200K will be managing that tension. Will you trust the math enough to shed the armor?
Or will you carry the armor while ensuring it doesn't slow down your primary engine?
I want to leave you with one final thought to mull over, because it fundamentally reframes this entire debate. We have spent this deep dive analyzing Munger's disdain for non-productive assets, dissecting the math of opportunity cost, and looking at the mechanics of compounding.
But consider the ultimate irony of the psychological barbell we discussed. If holding a small percentage of your net worth in Munger's dreaded rat poison and zero-yielding metals is the exact mechanism that prevents you from panic selling your equities during the next catastrophic market crash,
Doesn't that ironically make those non-productive assets the ultimate protector of your compounding?
it really does. It suggests that the pinnacle of investment strategy isn't about perfectly executing mathematical models in a spreadsheet.
Right.
It's about deeply understanding your own psychological flaws and deliberately tricking your own brain into staying the course.
If the rat poison keeps you from poisoning your own portfolio, well, it ceases to be poison. It becomes a cure. We want to warmly congratulate you again on hitting this incredible milestone.
Yes, huge congratulations.
Thank you for allowing us to analyze your specific hard-earned portfolio on today's deep dive. Take these frameworks, weigh the math against your own psychology, and map out your path to 200K.
Keep learning, keep building.
And whatever you do, let that compounding engine run. We will catch you on the next one.